Good afternoon, everyone. This is Sacha Pradyuman of Cirrus Research. 26 days into this Iran war, since it started, kicked off by Operation Epic Fury, the war has opened fissures that were both seen and unforeseen as Iraq dug in deep, turning on its neighbors to widen this conflict. We are now in a dual conflict that has metastasized from one country to a region, a conflict that is opening a military level as well as at an economic warfare level. There's massive tail risk that's running our portfolios in this period as the Strait of Hormuz is effectively cutting energy flows globally by roughly 20%. Now, oil prices have rattled around as Brent has gone really from the lows of $66 a barrel to the highs of $120 a barrel. And the recent terms of a ceasefire are starting to surface, with possibly Pakistan, among others, acting as an intermediary. Now, experts, and there are many, believe the terms on the ceasefire appear to be far apart. Overnight, WTI has started to climb from $90 to $93 a barrel. This is a massive amount of uncertainty that makes it tough to chart the course for a portfolio looking 6 months or a year out. Also, a tough time to publish or hold a quarterly market outlook. With all the disclaimers aside, let's get into it. The title of the dispatch report, Shortening Portfolio Duration as the Iran War Lengthens. It offers some means of traversing this fat-tailed moment. The most direct impact to portfolios is likely transmitted through higher rates. As rates climb, valuation multiples compress. The likelihood of inflationary shocks are also likely, given that we're likely to further pressure profit margins. Now, this creates a very challenging earnings season in the making, as analysts are more likely to be adversely surprised. As a result, we begin to see firms with lower multiples outperform, or at least appear to be less affected. We also see commodities, energy sector continue to climb higher. Income, dividend yields matter, as investors will likely take a more defensive crouch, effectively shortening their duration. So today, a bunch of things to go through in sort of like an outline form. We'll talk a little bit about the rotational market that we're currently facing. Some of this is really totally tied to the war. We'll bring in some of the tactical model readings that also seem to support this lower equity duration. In fact, one of the big things in some of these slides that we'll go through today, it will link that prior to the war, this sort of rotational market that we've been living with in the last 12 months, I think, if anything, this war exacerbates some of that setting. So in many ways, this is a knee-jerk moment, but not a lot changes in the sense that globally markets are broadening. A couple of things that sort of drive this is that the decade-long sort of margin highs the U.S. Markets, U.S. large cap represent, really are the undercurrents of this market rotation. Mega cap leadership currently stands with a near perfect margin as the world seems to be fracturing. The past cycle data also indicates that key groups such as small caps, international stocks, emerging markets, they've sort of tracked together in past decades. And so new research, we'll go through some of this in the back half of the call. It does argue that these three groups in the last year, if you've observed that they were starting to outperform and U.S. large caps were lagging, it's not an anomaly. In fact, if we go back through several decades, we'll see that they're quite linked. Underneath this, we think, is the sort of measures of geopolitical risks. Gold can be seen as a proxy for that. I suppose there's a bunch of others, but it has been a useful indicator. The nice thing is there's plenty of data and it goes back decades. So we'll dive into that as we get going here. So let's jump into it. In terms of where we were about 6 months ago, which was really all things AI, has suddenly, really in the last 5-6 months, has really reversed course, paused, and it's become a little bit more extreme because of the war. But the changes that we're seeing today have been underway for the last 6 months. Absolute returns, we're not shocked. Like the energy sector is up quite a bit in the 20% level. Gold's up, even though in the last few weeks it has reversed sharply. Material sector is also doing well, and oil, as we know, sort of like playing on this moment day to day with the war. On the other end, we've got the Mag 7. This is through February, but it was down at least about 6-7%. Some of the private credit players like Blackstone were down over 20%. Bitcoin was also down sharply. So these are things that are telling us that we've got a very rotational market here. We've got event risk. So a bunch of things are like sort of meeting at together. If we step back and look at some of our tactical models, though, this is super interesting that in terms of risk appetites, that the US, until about 4 or 5 months ago, we had seen sort of like peaking of historical risk taking that actually went back to in an extreme as far back as 1999 with the internet peaks. So what we've seen, though, is a massive reversal. But I think what I want to underscore in this call is that the reversal that we have seen from the risk measures, they've come from very high to the point where they're still actually currently above normal. In other words, as investors consider how much of a defensive footing they want, what this is telling us is that there's plenty of more speculative players on the line. And we could see quite a bit more of a retracement in risk-taking and ultimately to a point of being more defensive. Our CRX measure, the Cirrus risk score, that is a proxy for the US risk appetites, and that has come down. And I think one of the important takeaways from these things, though, is that markets rarely go to fair value in reverse. So if you look at the last year, yes, speculation climbed, but it didn't just hit some sort of long-term average. It went well above that. And in the same spirit, the longer this war continues, the more likely we will see an overshooting of risk preferences. So the fact that we're not at this very low end, a contrarian bottom, at least by this simple measure, tells us there's still more room that we can use to adjust the portfolio here, especially as the sort of length of this war seems to be extending. To put some of our tactical measures together in the last 6 months, where we were back in the fall was a period where both our risk appetite taking and market crowding was at peak levels. They're at that, if you think of it as a clock face, of the 11 o'clock to midnight reading was really where we were. And so we've seen a sharp retracement. But in terms of market sort of patterns, where are we at? So if you were to go back to a period where these risk measures are at the 11 midnight type of reading, in that type of setting, aggressive strategies tend to lead. Momentum factors, beta factors, they tend to run quite hard. Now where we're at, which is more past midnight towards that 2 a.m. sort of reading, which is a period where momentum breaks, value and quality factors start to outperform, leadership is sort of reversing. So defensive strategies tend to lead. I would argue that this was already underway before the war. So the fact that you've thrown this sort of curveball into this sort of market rotation, maybe it makes it more extreme. But nonetheless, I think that's kind of where we are, which is this sort of broader, more value-leaning world. And by the way, lower multiples, higher dividends, all of those things are shorter duration. Now, what we're sort of more focused on are what the next couple earnings quarters are going to look like. And what we tend to do is look at where expectations are for the forward year. And in many ways, there tends to be, if you look at earnings revision in terms of time series, it can be quite mean reverting. And I think what's important here is ideally, given the sort of potential risk we see to earnings, for instance, if rates begin to spike, we could see the cost of capital continue to rise. Bear in mind, if you look at a long-term tracking of credit spreads in the US, credit spreads have been historically low up until maybe 2 months ago. You're looking at 30-year lows on credit spreads. Those numbers have started to widen, but we're still at the low end. So what happens if we start to see oil prices remain where it is, or in fact climb higher? The input costs for many companies are going to start to rise. So if the margins start to get squeezed, cost of capital starts to go up, we could see where the earnings season could become incredibly sloppy. Now, at the forefront, travel, farming, chemicals, et cetera, those are probably the most direct areas. But when we step back and look at these sort of CapEx demands, the promises that are sort of laid in front of us for AI, the cost of capital, if that goes up, by definition, CapEx spending will slow. There's just no debate about it. If credit spread starts to widen, the cost of funding is going to go up across the board. So when we think about the next few seasons, the couple of quarters that are coming, does it make you feel really confident? And so even if we were to come to, say, a very sudden end to this war, some of the challenges, if you think about fertilizer as it's really been held up, prices are going higher. What does that do for the growing season? If you notice around us, our days are getting longer. Effectively, we're in prime farming season right now. And so as a result, we think that these are the sort of margin pressures, the inflationary measures that are going to ripple through in the next few months. And that's why this sort of defensive, shorter duration posture will make sense. We talked a little bit about margins, and the US is in a really unique place. We're looking at sort of 30, 40-year highs with profit margins. The US large cap margins comparison right now, this is EBITDA margins, they're near 25%. This is about as good as it gets in the US. The large cap space is always more aggressive than the smaller cap space. So that is something that in many ways, if you get a downturn, the impact to earnings could end up being more significant in large caps because they're amplified more because of the higher margins. The other data point is that you started to see in the last 6-9 months some noise in the way the AI stocks have traded, large tech has traded. In fact, year to date, we could say, or in the last year, we could say large industrials have outperformed large tech. But what's underneath that, I think, is that the hurdle rates are so high. You've got the tech sector margins now roughly at 40%. If you drill down a little bit into the groups, clearly we know semis, the AI-related semis are driving a lot of that, which is near 50%. So that's really what's got investors struggling well before the war. So I think whatever's been going on, I think maybe this war exacerbates it because of the cost of capital concerns that will surface. So at the end of the day, though, if the hurdle rates for margins are this high, what could go wrong as partners are starting to step away from each other? So the global trade really does affect margins. And if they're especially high, especially for the large US large cap stocks, to some degree, this is what's the concern. This is exactly why I think globally markets have been rotating. What we've seen in the last year is incredibly dominant emerging market returns. International stocks outside of the US have done very well. And in the last year, US small caps have started to come back in a big way. I think they're very related to this bigger issue instead of just the last few weeks of the war. As a result, as many of you have seen, we will continue to really, we'll continue to see the quality bias that we've had really become maybe more amplified, especially if rates, oil prices remain in this sort of overhang situation. In terms of the portfolios on the growth side, we'll continue to lean into the high quality growth. In terms of value, the high quality value blend makes the most sense. In other words, you're in a world where valuations probably matter more. You're in a world where earnings visibility is going to matter more, and maybe even more tamped down expectations on margins. Changing the sort of the focus here, we've put out this market intelligence comparison over the years for sectors. And in this instance, we're focused on the smaller cap arena. We've also generated this for the large cap segments as well. A lot of the times they tend to be similar, but there are notable differences from time to time. But the real thing takeaway that I want to flag here is that the sort of green or the sectors with the best scores, they're in the staples, business services area, and materials. On the other end, real estate, telecom, industrials. And I want to drill down on industrials a bit, but if you were to step back for a moment and look at this skew, effectively we're going to lower CapEx. We're going to play a little more defensive with staples, and materials has got a win here. Maybe it's a double win, partly because of the power generation, the AI spending that's going to go on. But in addition to that, when you think about gold that's run up, or for that matter, oil. So it does feel like materials will be the exception to the rule when you use the term defensive. But taking a closer look at the industrial sector, we've warned in the last few months about the smaller cap industrials. They've performed incredibly well. The small cap group has really sharply outperformed the larger cap arena, and so has the micro cap space. And I think to some degree, this industrial segment is really benefiting from both the sort of power generation interest and the AI data center demands. As a result, investors have found it very easy to chase after these groups. This is especially true if you're in the small mid-cap arena when you can't necessarily buy NVIDIA in the portfolio. So in many ways, the industrial segment has become this sort of AI proxy for core/value investors. This is another reason I think you're seeing this especially inflated. When we drill into this sort of leadership within small caps, to no surprise, industrials have really led the charge. In addition to that, has also been healthcare, biotech. But in terms of the valuation comparison, the one cautionary tale here is that the industrial sector in the smaller cap arena is notably expensive. As a result, we are starting to see, because of the industrial cluster, a crowding that's starting to surface, which may have explained why we've seen such a sharp pullback in some of the leadership stocks in small cap. We could attribute this just to sort of knee-jerk sell-off in small cap land. I don't know. I think some of this has sort of been building up in the last year. But this is certainly something that causes us to be, caution, even though we like the industrial sector. If you look out in the next few years, the demand for power, data center, all of the rollout for AI processes, they're going to sort of really come back to the industrial sector. So we like it. It's just that I think everyone seems to agree. And so this does put some caution here. When we look at the earnings expectations, what's curious is that earnings estimates for the industrial sector, both large and small, had retraced a bit. And to some degree, I think this is good because it does put a little bit more of a reality check towards what growth rates they can be. Again, if we do hit some sort of interest rate backup well beyond where we've been really moving, CapEx by definition is incredibly cyclical. So this is something that we're going to have to watch closely. Bottom line, if the war is shorter, this is good news for these sectors. If it runs longer, if oil prices continue to spike higher, this is going to be a real problem, and really underscores the need to play even more defense. Right now, it really is tough to sort of become terribly too bearish, but this is the stuff on the wings here. Another area that we have focused on has also been the application software space. This is really related to the AI disruption that investors have started to really attack. The question has it gone too far? And what we've looked to is, to some degree, has been not so much are the stocks weaker, but are the forward estimates being retrenched. In other words, the growth outlook for these companies are going to be massively adjusted. Not all of it's bad, but the way the stocks have sold, in fact, if you look at the larger cap application software groups, they've lost nearly 50% relative to the tech sector moves. Whereas in the smaller cap area, more like 30% relative to smaller tech. Bottom line, though, the sell-off has been dramatic. We've seen some recent trading periods of some stabilization. I think that's good. One interesting thing is that the forward estimates for the application software area, they are starting to come back down. And this is good news because to some degree, the only way you're going to get investors to come back to this group, because, honestly, the application software space is incredibly powerful. It's going to work very well in an AI world, but there's definitely going to be winners and losers. And right now, up until this period, I should say, it really has been a free-for-all in terms of the sell-off. This might be tied as well to the sort of basket ETF trading of the retail investor. That's still to be seen. But at the heart of this, we like the fact that the smaller cap earnings expectations have come back nicely. Really, they were in the 70-75% handle in terms of estimates being raised for the forward year. That number is now like 55%. It can go lower because, clearly if we saw during the real awful period around the pandemic, these numbers were in a, like, let's say, 70% of estimates were getting cut. So we don't foresee that. But the fact that it's down as much as it has in just the last few months is really constructive. It means that you go into the earnings season, this stuff, there's a greater likelihood you're going to get positive earnings surprises. And then also looking at the bank sector, I think this is super interesting. We've been more cautious. We've liked the banks. Part of it has to do with the underwriting, especially with all of the AI-related firms that are going to surface. In addition to that, we've seen a steeper yield curve. Loan growth is likely to pick up. The big beautiful bill also offers up a ton of tax breaks, which encourages investments in CapEx up front. So these things are generally good. However, what we've also seen is that the sell side forecasts have been incredibly optimistic. And in these periods where the capital markets are starting to wobble a bit, especially because of the global environment, this is something that we've got to be somewhat cautious on. We've seen the banks run, and can people start taking profits? Can people start to, let's say, taper off their bullishness? Absolutely. And so in this window, I think at the heart of it, as the markets pull back in the last 6 months on tech, it certainly pushes the underwriting window out a bit. So I do believe that's part of the puzzle here as to why the banks are struggling. And I don't think it's an overnight factor. I think we do need to see some clearing of this sort of global conflict that's going on to see the financials really reclaim the ground. Again, we like the space. We think if you go out a year from now, as the dust settles, this is good. We should see the loan growth activity pick up, especially because of the data center power demands investments that are going to be underway. So definitely an area that we're going to be more selective on. So what I want to do now is jump to some new research that actually ties back to a lot of the rotation that we've been describing. But from this point, what I'm going to do is take a step back and look at it more from a longer term historical pattern. In the last 12, 18 months, I think enough of us have observed how, you started to see the US markets start to lag, and you started to see international markets start to outperform, emerging markets start to work. Since the April bottom, we started to see smaller stocks come back to life. And so what we started realizing was that, I guess the question became, is this an anomaly? And when you look back at long-term data, well, the answer is no. These things tend to move together. In other words, if you see a pickup in geopolitical risk, it forces investors to become more valuation sensitive. It also creates more of a rotational market. And really, that's what we've been living in. And as best as we can frame this, if you look at the concentration in US large mega caps, it's pretty severe. There's a heavy allocation to US large cap growth. But at the same time, what we've also observed in prior reports is the valuations between the US large cap market and the rest of the planet was extreme. The valuation between US large cap and US small caps, again, extreme. So we know that the large cap market is expensive. The counter to that is, hey, look at all the growth opportunities that are going to be in these larger cap names. We've in the last year countered that by saying, look, the opportunity in AI is going to fragment, and it's going to really benefit a whole lot of industries that are outside of just NVIDIA and the short list of few. And so the sort of fulcrum on this trade, this rotation, we think geopolitical risk really is the sort of factor that drives this. And to some degree, when you observe gold starting to climb to new highs as it has in the last year, it's quite possible that that could be used as a proxy for geopolitical risk. So maybe it's really no coincidence that gold has started to turn. And as a result, you also are reflecting that investors have probably gotten more nervous, not just in terms of selling risk assets, moving to gold, but also paying more attention to valuations. And so we think that, if you go back to last year with the tariffs, what that was suggesting was that, hey, you're now causing trading partners to sort of step away from each other. And so if you don't have a smooth flowing global supply chain, the perfect margins we're witnessing right now in large mega caps, that is something that's going to become questioned. And to some degree, that's what's really causing this rotation. So the rotation is really at two levels. One is this idea that globally, people are starting to fade a little bit of their exposure. They're adding gold, but they're also becoming a little more valuation sensitive. And because of where the value extremes are, that's what's sort of moving this together. In fact, if you go back over time, we have seen something like this. In the 70s, for instance, a very, inflation-driven world, gold ran. But guess what also happened? In a bear market, small caps sharply outperformed large for almost a decade. As you went through the Volcker shocks and we became more disinflationary, less sort of geopolitical angst, we started to see gold fade, US markets start to rally, but at the same time, we also had small caps really underperform for multi years. And so when we now go back, if we look towards the 2000 and 2010 window, another period where we sort of see a bit of global expansion, China investing and so on, and gold prices start to rally. Guess what? In the US, smaller stocks outperformed large significantly. And so what we're witnessing this year in the last 18 months, it's quite possible that we've seen this before, and this rotation makes fundamental sense. In terms of specific periods, take a look at the full report. I won't go through all of it, but at the heart of it, though, what we have noticed, the tails to this story are large growth on the one end and small cap, small value on the other. If you look also international markets, they've also been favored, and emerging markets have done especially well. In the current window from 2024 to present, what we've seen is the emerging markets have gone up roughly about 25%. Developed markets have gone up about 16, 17%. So in other words, this rotation underway, it is something that we're witnessing and we've seen before. To sort of run this through a decision tree, this diagram, this flow chart, does a neat job of it. The idea is that if geopolitical risks are high, how do we measure this? Tariffs, war, inflation. You could probably pick gold as a proxy for this. You may even be able to use currencies. For the data we use, we ended up using gold prices. So if geopolitical risks are high, gold prices are rising, it then by definition says that valuations matter. If large cap valuations are high relative to small, then by definition, small will likely have an edge. If, however, small cap valuations were high relative to large, it's quite possible that the rotation would go to large caps. In other words, geopolitical risk doesn't necessarily tell us that small caps, emerging markets, international work. No, what it says is that if they're at significant discount, then they start to matter. The additional variable we've brought into this equation, because we could leave it at valuations, but the other proxy for this would also be margin comparisons. And I bring this up because when we think about trading partners backing away from each other, and you think about the global supply chain, how nicely fine-tuned it had been, to some degree, the reason the large mega cap margins are this attractive is because of really the trading relationships we've had for decades. So if that starts to fracture in any way, that introduces additional margin risk to the earnings story. So if large cap markets margins are especially high, that does give the small cap story an incremental edge, and vice versa. So historically, small cap margins by definition are lower. That's why they're small cap. But the question isn't so much who's higher or lower. The question is which margins are going to break harder because the valuations are priced for those high margins. So bottom line, this broadening we've been living through prior to the war, I would argue that as the dust settles here, we will go right back to that because these comparisons are fairly extreme. If you take a look at the US markets, whether it's large versus the small mid-cap market, we're looking at decade-long wide spreads. And coincidentally, the same with the developed markets versus the US. And this is really what caught our eye in the last couple of years. We started to notice the similarities of these extremes. And to some degree, markets will start to arbitrage this if they start to see geopolitical risks increase, relationships start to break down, and as a result, question, pitch perfect margins as we currently have in the large mega cap space. I said earlier that we've all been focused on AI and tech, but if you step back for a second, the broad US large cap market, the margins are about as high as they get. The technology sector is certainly the eye of this with nearly 40% levels in terms of EBITDA margins. So this is the setup for why I think you have a much longer term rotation here. In fact, if you look at the last few trading sessions, mornings we'll get up, and I think all of us are doing the same thing, wondering is the war going to end or does it get worse? And we're all looking at oil prices and listening to gosh knows how many experts. But what I've noticed is in the mornings and the days that you start the day where there's some improvement and a rally in oil, guess what's been happening? Smaller caps have been outperforming, emerging markets bounce, and gold bounce on a day like today because we're seeing a backup in oil prices as some of these floated agreements seem to be very far apart. We saw an increase in oil prices and we see a reversal again. So this current period is going to be very noisy, but what we're trying to do is look through this to say what is more of a status quo that we're migrating to. And so I think this is a big deal. A couple of numbers for you, the year to date, these are through the February numbers. We had noticed that both that in large and small stocks, that the value benchmarks were sharply outperforming each other by 400 or 500 basis points in the large cap area. Guess what? With the war and the pullback, pretty much what we're seeing, that the Russell 1000 is down about 3.8%. But guess what? Russell 1000 growth is down about 8%. Russell 1000 value is down about 1.3%. In other words, the spread that we were seeing, that 4 or 5% spread that was there before the war, that's pretty much the same spread now. So if there's one takeaway, the real question here isn't to try to game the war, because good luck trying to do that, but to step back and look at the broader pattern. And it does, I think we can make a really good case that markets are broadening globally. So I think that does it for my prepared remarks. The key takeaways is that this rotational market, it's going to spin on Iran's axis for now. The tactical models we're running is saying there's plenty of room to be more defensive. We continue to caution, though, that you look through this war, and we will get through this. The bottom line is that more high margins are going to be suspect if trading partners continue to fragment. And so leadership, as it stands, with near perfect profit margins, is going to be a challenge as we get into a world where you probably have some sort of input price shocks that are likely to come. We talked a little bit about the new research that we've been doing to sort of suggest that, we're big into the sort of connect the dots with markets. And I think this is one of the coolest things that we've been able to write up, which is this international emerging and US small cap observation of how they've moved together in the last 12, 18 months. The wild thing about it is, like, we've seen this before. In fact, it's a cycle. Take a look at the full report. It came out in the dispatch. It was the second half. The white paper section of this is there. And always, really happy to take your questions. Thanks very much for joining us today. Much what we're seeing that the Russell 1000 is down about 3.8%. But guess what? Russell 1000 growth is down about 8%. Russell 1000 value is down about 1.3%. In other words, the spread that we were seeing, that 4 or 5% spread that was there before the war, that's pretty much the same spread now. So if there's one takeaway, the real question here isn't to try to game the war, because good luck trying to do that, but to step back and look at the broader pattern. And it does, I think we can make a really good case that markets are broadening globally. So I think that does it for my prepared remarks. The key takeaways is that this rotational market, it's going to spin on Iran's axis for now. The tactical models we're running is saying there's plenty of room to be more defensive. We continue to caution, though, that you look through this war, and we will get through this. The bottom line is that high margins are going to be suspect if trading partners continue to fragment. And so leadership, as it stands, with near perfect profit margins, is going to be a challenge as we get into a world where you probably have some sort of input price shocks that are likely to come. We talked a little bit about the new research that we've been doing to sort of suggest that, we're big into the sort of connect the dots with markets. And I think this is one of the coolest things that we've been able to write up, which is this international emerging and U.S. small cap observation of how they've moved together in the last 12, 18 months. The wild thing about it is, like, we've seen this before. In fact, it's a cycle. So take a look at the full report. It came out in the dispatch. It was the second half. The white paper section of this is there. And always, really happy to take your questions. Thanks very much for joining us.